say you're on the fast track to FI, say that's within 15 years,
Yeah.
and you want to start thinking about adding bonds to your portfolio. So, say currently you're about halfway through and you're still 100% equities. When do you think is a good time to start adding bonds to your portfolio? I'm especially talking about the people that are pretty fast to FI, the people that are trying to get there within 10 to 15 years. And a little context, I am a young adult. So, kind of what are your thoughts on when to start adding bonds to your portfolio? Would you say about once you're 75% of the way there? Is there a number that you should get to? Just what are your thoughts?
Man, this is a great question. And it's not one that I have like a prescriptive answer for at this particular point in time. I will just say that I plan on being at financial independence easily within 15 years and likely inside of 10. Yeah, I'll be at FI within 10 years very handily. And at that point in time, at what point would because right now I do not have anything in any bonds at all right now. I have zero bonds. I am trying to diversify my portfolio. And so I have, a lot in, index funds as we talk about. And, there's some pivots there between whether it's cap weighted or whether it's, kind of being a little bit more diversified and having some in small cap and value. You've heard the conversations that we've had with Paul Merriman. But largely it's, we're looking at an equity-based portfolio with no bonds. So at what point do you start getting more conservative? And I think for me, it's probably more in terms of once I have a clear exit date in mind, I guess, if I knew that I'm going to be needing to do drawdown inside a period of like 5 years, personally, it's a personal answer. I'm just kind of sharing what my personal mentality is. I'm starting to think about what's going to derail that. And would a big event, going into that last year, or right after, would that scare me or terrify me? And then at that point, I'm saying, do I need as much growth for this last 5 years, or do I need to have some sort of ballast in place, something to smooth the ride? So for me, it's kind of more of what's my plan post-retirement? Am I going to be earning income on the other side, or is it just a transition to something else? And how far out till I'm planning on walking away from whatever that current form of income is? Though it's a combination of those two. And then as to the actual percentage, 60-40 is that old traditional kind of standard advice of 60% bonds and 60% stocks and 40% bonds. It's a very personal choice. I think J.L. Collins says it the best. It's what allows you to sleep at night and just basically your risk tolerance. We could have that episode linked up as well. For me, I probably will not be quite that conservative, but what I might do is something along the lines of 20 or 25%, bonds or some sort of safer, less volatile vehicle. And then I might, taking a look at what Frank has talked about, I'm going to start really looking at what is the point of these? Am I looking for stability? Am I looking for income? Am I looking for negative correlation? And I will probably start doing some research around that. So it might look like, some sort of speculative investments for a small piece, maybe something in precious metals or in crypto or something like that for a small percentage. But that's kind of just like a general thought process. And again, the big points that I wanted to do here is I usually would say, for me personally, if I know I'm going to be within about 5 years of my expected time of needing the money, that's when I plan on starting to be more conservative with my investments and starting to make some adjustments, basically planning out a glide path to my exit date. Brad, I know yours looks a little different, but you're farther on the path, so maybe you could have a different opinion from mine.
Yeah, I will definitely go into that. Do you recollect that Big Earn talked about paying off a mortgage as a potential alternative to bonds?
That is a great point. And yeah, well said. Let me find the episode while you kind of talk about your strategy, and then I'll give you that number.
Cool. Because I think that's really important information. that could definitely help. So, because right, mine is just going to be kind of an anecdotal answer, which is, obviously this is a great question. I personally am not stepping off of the equities gas pedal, let's say, even though I'm at financial independence. I personally do not have any allocation in bonds whatsoever. So for me, I don't know, like there's not some prescribed amount. There's not like, these are the rules, or like you said, the traditional amount is 60-40. I think, people, it's going to be individual preference, and it's going to depend on your timeline. I know you said you are a quote unquote young adult. So, that suggests to me that you're, maybe in your 20s is what I'm kind of guessing. And you're talking about a fast track of 10 to 15 years. You have a really long time horizon. So I'm not sure that I would personally, and this again is not, exact advice for your situation, but like, I'm looking at what's the highest likelihood of maximizing my net worth and making sure that this lasts me throughout my life. And I think for me, equities is where I would choose. So I'm not sure that I would put any significant amount in bonds. That said, Jonathan, to your point, there are other options. That doesn't mean I'm not looking for, if I had something that could guarantee, and I use that very loosely because it's not possible in 99% of cases. But if there was all of a sudden a bank that paid a guaranteed interest rate of 5% or something, which amazingly enough was the actual case when I graduated college, which dates me quite a bit. But online banks paid 5% at that point. So, if we got into some crazy environment where that came back, I mean, that's not too shabby, right? To guarantee that, especially when, I need a 4% safe withdrawal rate and I'm guaranteeing myself 5%. If I could absolutely lock in a 30-year guaranteed 5%, yeah, I might consider that for some percentage of my net worth. But again, I'm just kind of setting up like a funny example of like how I would approach this mentally, because I think that's really the answer. Is we're not going to be able to give you an answer for every single situation you face, but how do you think about the problem? So I mean, that's roughly how I would think about it.
Well, you dropped a lot in there. I think it's really important to actually structure that a little bit in terms of like, what are the variables to consider? And I think it's probably worth pointing out a few things came to mind. So one, first and foremost, bigger, and I think it's going to be episode 152R was another good one we had with Big Earn, ChooseFI.com/152R. And then let me give you guys a couple more here. Find them all. Episode 66. So ChooseFI.com/066. I think these are the two. It's ChooseFI.com/066. The emergency fund. Is it a bad idea? I think he talked about the glide path at the end. And then ChooseFI.com/035. Sequence of return risk for early retirees. Those are both the two big ones. All right. Now, going back to this, the thing that Brad just said, creating your glide path, if you can decrease massively your structural expenses at the point of retirement, what I would say that would mean is you could treat that in some part like having bonds. That's a case that Big Earn was making. That would act as a substitute for having a hefty amount of bonds, because the actual structural costs of your life are so much less, because you don't have a $1,500 mortgage, a $2,000 mortgage, a $3,000 mortgage, because that's gone. That is a structural expense that's gone. And now the bonds that you would need to make sure you always had to cover that may not need to be there. Bonds are not very attractive right now, right? I mean, they just haven't been super attractive for several years. And so I think all of us are kind of like, oh, what else could I do? And people look at it different ways. Some people just end up having a big cash cushion, so like, hey, I may not have any bonds, but I have 2 years in cash. So if it hits the fan, I'm good for the next couple of years regardless. Is that the most efficient way of doing it? Maybe not. Big Earn would say absolutely not. It's a huge cash drag. other people like Brad, like to Brad's point. So one, on the other end of financial independence, you created multiple kind of relatively, until ChooseFI at least, it was relatively passive income businesses that didn't take. So that's another thing that a lot of people are doing, and they have income on the other side. Really what reaching financial independence meant is they stopped working for a corporate, right? They were just done with corporate work. They were just doing their own thing. Maybe it's something that they wanted to pick up, and that starving artist syndrome really kept them from pursuing it. Now they're creating for the love of creating, and they earn income on the other side. Or if that, I mean, that massively changes your risk tolerance, you know, and what sort of allocation you need if you're going to be earning even any sort of income on the other side. And a couple other things that you could add onto this just to balance it out is, how much flexibility do you have in there? So Big Earn likes to kind of say, well, you're going to need to be more flexible than you think. But I think it's worth pointing out that someone that's hard, like pursuing financial independence aggressively, thinking they're going to hit it in 15 years on this side, on the left side of 40, they have a lot more runway than someone that's just eking out financial independence at the age of 67 while accounting for Social Security. They're just barely hit their number. And as long as nothing breaks, it's going to be fine. They don't have as much flexibility in that plan as the individual that, they could work. They could earn more. They could go back if they needed to. And I know that there used to be the old, you can't get jobs during a pandemic, or what type of job are you going to get? Well, that's been proven because we had a perfect case study this past year that we had individuals that lost jobs making 35, retrained. We just talked about at the beginning of this episode, and the job's paying 60 to 80, right? That is a perfect case study for the fact that, like, if you have good information and you can act on it, you can get a job that pays more than it pays right now in the worst of worst times. And so, your degree to be willing to be flexible if something were to come at you, and you're willing to accept that is a possibility, is that work? Because the counterpoint comes with the cost too. You being too heavily weighted toward bonds may mean that you're working 1 year, 2 year, 5 years longer than you need to work. It's not like just going to bonds locks in the date that you want. You could have been there multiple years sooner. How much is that security of knowing? How much of your life is it worth to have that? That's kind of like the value judgment that you have to play. And Brad, to your point, like, I know you're a little, you like your cash a little bit more than I do. And on my end, I did say bonds as this theoretical thing that I'm going to have to grapple with as I get closer. But I can tell you right now, I don't look at bonds and say, "Woo, I wish I had more of those." It's just, you got to make a decision based on the variables at your disposal at a particular point in time, knowing kind of what you want on the other side.
Yeah, agreed. It's just like anything. It's personal finance is truly personal, and you need to figure out where you're coming from. I know that sounds kind of cliche, but it really is true. There are things that are, like we always say here, there are things that may be more mathematically optimal, but if you don't sleep well at night, is that really the right decision for you? And for me, I very strongly factor in that, do I sleep well at night test. It matters for me. So
I will say though, one thing, one more. I will say though, you said it, and I realized before I walk away and I go into drawdown, I have decided, like, I am going to pay off my mortgage. Like, I know that 100% before I'm actually technically drawing down a dollar. Before I'm in that place, I want that structural expense gone. Many people are happy riding it out through drawdown, but for me personally, I'm not going to pay it off early now. I'm going to let my equities roll. But when I get close to that retirement date, I'm going to get rid of that mortgage and get that structural expense off of my books. And that massively changes the calculation on what your FI number is and needs to be on the other side.
Yeah, I mean, it's obviously a massive, massive expense every single month. So yeah, it's huge. And actually, Big Earn, so on earlyretirementnow.com, he has the famous Safe Withdrawal Rates series, and part 21 is why we will not have a mortgage in early retirement. So I think that answers the question. And Jonathan, that also goes with your thought of, hey, it's just not going to be part of my FI plan. So yeah, that's thank you for the questions. And Jonathan, I think we're gonna wrap this up for now.
Send in your own voicemail by tuning into the next live event at ChooseFI.com/live.